Welcome to Talk Tickers. We're the place you come to get the real story behind the biggest earnings calls.
All right, today we're jumping into the FedEx Q1 results for fiscal 26. We're going to hit the big headline beat, dig into what's really going on inside the numbers, check out what management is saying about the future, and then, of course, give you the big investor takeaway and our official call on the stock. Let's get to it.
Okay, first up, the headline beat. And wow, did FedEx deliver a solid quarter or what? They really surprised the street on this one.
So, the number everyone was laser-focused on? Adjusted earnings per share. And they came in hot at $3.83. That's a solid 6.7% beat over what the street was looking for. Pretty impressive.
And you can see it right here, that gap between what was expected and what they delivered. I mean, that's not just a rounding error. A 24-cent beat like that tells you something real is happening. It's a huge signal that their cost-cutting and operational discipline are really starting to pay off.
And hey, it wasn't just about earnings. Look at the top line. Revenue hit over $22 billion. Not only did that beat what analysts were expecting, but it's also up over 3% from last year. And remember, they're doing this in a really tough global environment.
So, where did this extra revenue come from? Well, it was almost all about their U.S. domestic business. It was just surprisingly strong, showing a ton of resilience. It was so strong, in fact, that it more than made up for some of the weakness they're seeing on the international side.
And the market? Oh, it noticed right away. The stock shot up over 5.5% in after-hours trading. You could almost feel investors breathing a sigh of relief as they took in these strong numbers and the confident tone from management.
Okay, so let's get into the nitty-gritty inside the numbers. Because this quarter was really a tale of two different stories. Incredible domestic strength fighting against some pretty serious international headwinds.
This really lays it all out, doesn't it? On one hand, you've got the good news. U.S. volumes are up, they're on track to slash $1 billion in costs, and they're buying back stock. They're doing everything right at home. But on the other side, you've got these international storm clouds. Export volumes are down, tariffs are a huge drag, and the freight business is still struggling. It's like they're trying to win a race with one foot on the gas and the other on the brake.
All right, let's talk about the future. What's management's plan? This is a big deal because, if you remember, they pulled their guidance last quarter amid all the uncertainty. Now they're back, and everyone was listening.
And here it is, plain and simple. They're calling for revenue to grow between 4 and 6% and for adjusted EPS to land somewhere between $17.20 and $19. You know, just putting numbers out there again was huge. It gave investors that clarity they were craving and took a lot of the what-if uncertainty off the table. So, you might be asking, how are they going to get there? Well, they've got a three-pronged attack. First, that DRIVE program is all about finding $1 billion in cost savings. Second, they're going to simplify the business by spinning off the entire freight division. And third, they're continuing to optimize everything with what they call Network 2.0. That's the playbook, folks. That's how they plan to hit those targets.
Okay, so let's put it all together. This is the investor's takeaway. What does this actually mean for the stock? And the big question on everyone's mind is this the turning point?
And you really have to see this good quarter against the backdrop of a pretty brutal year. I mean, look at this. The stock is down almost 25% over the last year, while the rest of the market has been moving up. So when a report this strong comes out, it forces you to ask, is this the spark that finally gets the stock moving in the right direction?
And you heard it right from the CEO, Raj Subramaniam. His message was all about resilience. He's basically saying, look, our strategy isn't just a bunch of buzzwords on a slide. It's working. You can see it in the results. He's really trying to build that confidence.
And really, it all comes down to this, the bull versus the bear case. The bulls are saying, hey, look at their cost cutting, look at their domestic business. They're crushing it on everything they can control. But the bears are waving a red flag, pointing at global trade, at tariffs, at the soft freight market, things that are totally outside of FedEx's control. So the question for every investor is, which story do you believe in more? The internal turnaround or the external headwinds?
All right, we've looked at the numbers, we've heard from management, we've weighed the pros and cons. It's time for the next call, our take. Here's what we think is going to happen.
So, after all of that, what's our rating?
We're upgrading FedEx to outperform. Plain and simple. The execution this quarter was just too good to ignore.
And here's why. We expect earnings to get even better next quarter. We think the market is going to start paying more attention to how well the company is executing and less on all those macro fears. That should drive the stock up over the next 3 to 6 months. And the real key here? That billion-dollar cost savings plan. It's like a shield. It's strong enough to block a lot of those international headwinds, which will let their awesome domestic performance really shine through and push earnings up.
Now, as always, remember, this analysis is for informational purposes. It is not financial advice.